Good afternoon. This is Craig Moddelmog with Cornerstone Wealth Management, and this is this week's Wall Street X's and O's. Very appropriate, means we have the Rocky Mountain Showdown tonight. So for you CU fans, I wish you the best. For CSU fans, you know what? God bless you. I hope it's a good game. Last year, not so much. So anyway, on to the show here. Kick things off, I'd like to first wish everybody a very wonderful Labor Day weekend. And as those of you who are getting out and to do some traveling, I wish safe travels to everyone getting on the roads. For those of you who are getting on the road, I would like to inform you that the price tracking firm Gas Buddy, in which up to today, and whenever I get close to the camera like this, because this is uncut and unedited, literally, Gas Buddy predicts that the average cost per gallon of gas this weekend, $2.55. So hey, it's a weekend, you can save some cash. We like that. Anyway, on to really why we're here today. And like I said, what my goal is to really provide a few bits and pieces about what I'm watching, what I'm seeing, try to help clarify some things in the news and the markets, and more importantly, have a little fun. For those of you joining me the first time, uncut, unedited is legit. For those of you joining me for the second weekend, you will say, Craig's right. It is very uncut and unedited, which, hey, it's all good though, right? It's fun. It's fun. But to kick things off, let's really look at performance. This month was rough. We saw volatility really increase. We are seeing down performance numbers for the S&P, small cap US, developed international, and emerging markets. S&P down almost 2, small cap down almost 5, developed world down 3.5, emerging markets 6.5. The bright spot, this is interesting, long-term U.S. government treasuries plus, see I'm close again, 10.74%. Almost 11% for the month in bonds. You say, what's going on? Well, I think what we're seeing is in times of fear or high or rising volatility, money still flows to the United States, okay? If you go back 93 years of market performance, and we look at generically U.S. stocks, U.S. treasuries, and U.S. high-quality investment-grade corporate bonds. During that time frame, U.S. stocks have been down 25 times or 27% of the time. So of the 93 years, U.S. stocks negative 25 years of that 93. U.S. government treasuries, same statistic, down 25 times or 27% of the time. U.S. corporate bonds, investment grade corporate bonds, only down or declining 20% of the time, so 19 times out of 93. Here's the question: how many times have all three been down at the same time? Means I can't hear anyone, I'm just going to give it to you. 3 times. You see proof again, uncut, unedited right here. Anyway, 1931, 1969, 2018 are the 3 years in which stocks, government treasuries, high quality corporate bonds have all been down in the same year. Okay, that is big. What are we doing to hedge volatility? We are actually really focusing on our exposure on the bond side. It's a way to really mitigate or muffle volatility, specifically long-term treasuries, and also a little splattering of investment-grade corporates. So again, those are ways to diversify portfolios. And for you bond lovers, this is the best time of the year for you. For people that don't like bonds so much, you know what? On occasion, it is prudent to gain additional exposure to reduce volatility. That's what bonds can do. That's what we're doing. I anticipate this to continue over the coming months and quarters, where we will continue to maintain very strong bond exposure. In closing, the next several weeks are big. We got a couple things that I'm really dialed into in no specific order. U.S.-China trade. Do we come up with a truce? Short term, I think no. I think it's going to be continued bantering back and forth. I do think eventually they get a deal done. Fed policy, we've had one rate cut. We're probably in line for another one. Is it going to be 25 basis points or 1/4%? Is it going to be 50 basis points or a half? I'm leaning towards the half because right now we do have an inverted yield curve, meaning short-term rates are higher than long-term rates. Historically, that's not fantastic for the market. It doesn't mean that a recession is guaranteed, but the longer it stays inverted, the more pressure it puts on the markets. Economic growth. Does the economy continue to deteriorate both from a global standpoint as well as from a domestic? Right now, the U.S. is kind of cruising along at about a 2% GDP growth rate, which for an economy this big, not bad. So our growth, can it maintain these growth levels? Time will tell. Geopolitical risk. Iran, U.S.-Iran, is that going to escalate? I hope not. Iran, I think, is kind of pushing some buttons to see what President Trump does leading up to an election year. Lots of pressure. Lastly, the bond market. Do we get some stabilization? We've seen fear drive bond yields down. Remember, as people buy bonds, driving prices up, yields go down. They are inversely related. See, another uncut. That was the market closing. It's 2 o'clock in the afternoon on Friday. So it's going to be interesting to watch to see if we get some stabilization in the bond market. Again, time will tell. The next several weeks are going to be key. With that said, thank you for tuning in to this week's Market Wall Street X's and O's. Have a safe and fabulous Labor Day weekend. And again, on August 30th, 2019, this is Craig Moddelmog signing out. Thanks for joining me.